Hello again from Corewealth. The year of 2023 has started with quite a bang. The markets were up really strongly in January. We'll cover that in a bit more detail. And we'll also have a look at some of the thinking that's out there around what could affect the year as a whole and what we're expecting from different markets. So, big news headlines during the month of January. One was that inflation does seem to be starting to slow down in the US. We've seen prices around goods coming off, oil prices coming off. But the sticky point in the US at the moment is the salaries and wages. Those levels are not coming down enough yet, and that's something still to keep an eye on during this year. Then, if we have a look at energy markets, those prices have come down quite a lot. And winter in Europe was actually a lot less severe than people expected, and therefore they used less energy to keep themselves warm. That's been a good sign. And the other thing has been Europe has successfully transitioned from buying its oil and gas from Russia, and they now have enough reserves in place, much higher than last year, some 28% up, and also have enough to last them for the whole of next winter. Then the last big item has been the opening up of the Chinese economy. They were in severe lockdown because of COVID crises. They changed their way of handling it. They've opened up the economy, and people are traveling again. So this has been a big boost both economically, and so the economic growth for this current year is expected to be a lot higher and will actually offset some of the slower growth we're expecting to see in the West in 2023. So in South Africa, the big thing was our Monetary Policy Committee of the Reserve Bank met. They increased rates by 0.25%, was expected. We think we could be getting to the top of the hiking cycle. There may still be another 0.25% at the next meeting, but we could even see rates coming down before the end of this year. Inflation at the moment is expected to get back within its range of 3 to 6%, and will probably end up at around 4.5% later in this year. But there are still some concerns that inflation may still be a little bit higher than is necessary. The other side of things, from a production point of view, is load shedding continues to be a drag on our economy. The Reserve Bank came out with their predictions that the economy will only grow by 0.3%. We think that's probably too conservative if we look at a lot of other economists around the world and around South Africa. And at this stage, our expectations are between 1 and 1.5% economic growth in South Africa for 2023. So I mentioned earlier that this started with a bang, and you'll see from this table that equity markets all close to or even above 10% up for the month of January. Now, to put this into context, the South African stock market was up 8.9%. Last year, it was just below 4% for the whole year. So we've more than doubled the return in the space of 1 month. But last year was a shocker of a year. It was really tough, especially for global markets, and you can see a lot of that catch up coming through in the month of January. So the developed market shares up 9.7%, emerging market shares up even more, 10.5%, global property up over 11%. So a really strong month for global equity markets, and bond markets also coming up strongly for bond markets anyway, up 5.8% just for the month alone. Internationally. And then on the currency front, the rand was a bit weaker, down 2.4% against the dollar, and the pound now strengthening quite a lot, as interest rates are expected to continue to rise there, which attracts money to that currency. And so the pound and Europe strengthening against the rand by both of them by over 4%. And again, versus the rest of, if we look back a year, you can see the international market still struggling. If you look back over a year, just up over 4%, emerging markets actually down. But South African equity market over the last year to the end of Jan up almost 12%, and then our bond markets up just over 6%. So quite a big turnaround in January. So if we just have a look at the numbers more to the right, which are the longer term numbers, you'll see there global equities giving you great returns over 3, 5, 10, and 12 years. the South African equity market is now made up that sort of slump we had during the Zuma years, and we can see over the last 3 years, actually the best place to have been invested was in the South African equity market. And the longer term numbers now over 10 and 15 years, both of them above 10%. So just illustrating again that the place to get long-term returns are in the equity markets, but you do want to be diversified between local and global markets in doing so. So we have a look in this slide now how we have done in terms of the portfolios we're managing for our clients. These are our different South African models. You can see for the month of January, another very good month in two ways. In absolute returns, you can see there all the balanced strategies which have got exposure to equity between the lowest 4.2 and the best 6.8% in the 1 month. But importantly, at the same time, we are doing better than our peers, and that's where all those the green blocks are showing that. The 1 year numbers also, all of the funds outperforming their peers by quite a healthy margin, and then the longer term numbers again on a relative basis, all of the numbers nicely in the green. And what's nice to see is that we're starting to see those balanced strategies edge up, and some of them even go into double digits as we getting away from that period during the Zuma years where equity markets in South Africa were pretty awful. For our global clients, our international clients, this slide just shows our US dollar based strategies, and again, nice to see all the relative returns being in the green. So we're outperforming our peer groups. January was a good month, as you'd expect. You can see most aggressive strategy up over 6% in US dollar terms. The last year, the number's still negative on the back of 2022 with some really horrific equity markets in that period, but still relative to our peers outperforming quite nicely. And then the since inception numbers, which will hit a 7-year track record during 2023. You can see there that all of them nicely ahead of their peers. If we have a look at the next slide, which is showing again global strategies, but our sterling-based global strategies, you can see from this slide for the month of January, we actually underperformed our peers a little bit, and this was actually due to us having too much dollar exposure in some of our fixed income portions of those strategies. But that is a view that we're actually busy changing at the moment. But the longer term numbers, this strategy hasn't been running as long as just over a year now that we have been running this strategy, well ahead of its peers. But again, you can see because it's a relatively short period of time, the return since inception is actually negative. But that's just because markets have been really terrible over the period since this fund has started. All right, we're going to have a look at 3 big ideas that we think are going to be big drivers of things in 2023. The first one is a slide we're showing here is what the members of the US Federal Reserve, the Reserve Bank, are thinking in terms of where interest rates should be. And you can see where they were for 2022, where these members are expecting them to be in 2023. So you can see most of them, the blue dots, are much higher. And then importantly, the blue dots both in 2023 and 2024 are higher than what the market is expecting, which is the red dot. That for us is a little bit concerning, that the market is being over optimistic compared to what the Fed is doing, and that we think is a risk that could see markets still pulling back again, perhaps in the first half of this year, the US markets. The next slide that we're showing here just has a look at labor costs in the US, and you can see been relatively volatile. You can see how they came off quite a lot in 2020 and 2021 following COVID. But they have started to come down. Now the purple line is coming down, but still well ahead of its long-term average, which is the grade line, and still above 1 standard deviation. That's just a statistical term, which just means that it's really in outlying territory at the moment. So this is a concern that the year-on-year changes are still much higher than one would want to see them in terms of lowering inflation. And then this next slide actually then shows that in a bit more detail. And you can see the different color schemes here just showing services, which is essentially the the wage bill in the US has constantly been going up over the last year and a bit. Whereas things like energy have come down quite a lot. Um, Food is still a large proportion, but goods excluding food and energy have actually been decreasing. So the concern we still have is that the services sector or the wage bill is still too high in the US, and until that starts rolling over, you are not going to see interest rates drop in the US. So the second biggest economy in the world is China, and we're having a look here. Just it was in lockdown because of second COVID outbreak, and that's subsequently opened up in the last month or so, and we can see that the the population of China is traveling again. So the top graph on the left just showing passenger transport volumes up to close to levels that we'd seen prior to this lockdown. The congestion on the roads has picked up again, getting close to those previous levels as well. So China is working again. On the right, we've got just copper prices and the effect of that on the Rio Tinto share price, which is listed at the bottom there. And that copper price has picked up again, and that is because China is picking up again. Also, just because there is a shortage of long-term supply of copper. If we look through and look ahead as to what will be needed, for example, in all the renewable energy that's being put in place, electric cars, all of those type of developments are very hungry for copper, and that's a big tailwind for commodities into the future. So if we have a look at this next slide, this just shows the dark blue line, or is the expected growth that was expected out of China, the trend of that prior to the crisis, the COVID crisis. And then the blue line, you can see the impact of the different lockdowns in at the beginning of 2020, and then again from last year. And that has dented China's growth. You can see the light blue line is below the dark blue line, but there is opportunity for that gap to be closed potentially as China starts working again. And the forecast for growth in China for 2023, some economists have put them at over 5%. So quite a strong turnaround is expected this year from China, which will be good for emerging markets in particular, who have quite a lot of the resources that we've just spoken about. So a lot of information, but really our job is to try and find where we're going to see the tailwinds in the coming periods, and we tilt our portfolios accordingly. But at the same time, we diversified across industries, across regions, across styles of investing, to make sure we don't just end up either being sort of boom or bust. And the portfolios are positioned as such, and we trust that that'll continue to add to the outperformance we've seen over the last number of years. As always, get hold of us if you've got any questions. We've started our in-person events, so hopefully we'll see you sometime this year in person at one of those. Thanks very much.